I'm very pleased to welcome to the show Christine Benz, Director of Personal Finance at Morningstar. She's also the author of a few books. The latest is How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement. Christine, an absolute pleasure to have you. Really do appreciate your time.
Matt, it's so nice to see you. Thank you for having me on.
I really do appreciate it very, very much. Just for our listeners slash viewers here, if they might not have seen you or heard you before, kind of introduce yourself, give a quick background for our listeners and viewers, if you will.
Sure. So I've been at Morningstar, which is an investment research firm, for 30 plus years now, which makes me kind of a dinosaur. Most people do not stick around with their employers that long. But I've had a number of different interesting roles at Morningstar over the years. I had been a mutual fund analyst earlier in my career and eventually headed up our team of US fund analysts. But along the way, I got more interested in matters of related to financial planning, portfolio construction, things that we weren't really talking about with our great individual fund reports. And so I went through the Certified Financial Planner program in the run up to my current job, where I focus on personal finance and retirement planning. And I love that it's a really broad area. So I'm always learning, which is important to me. And I love that I get to share what I'm learning with the people who we're writing for and producing videos for Morningstar.com.
That's wonderful. And so a wealth of experience, of course, that you and interest that you bring to the table and to this discussion, especially. And I wanted to talk to you specifically because of not only the work that you do every day, but right now I feel like is a great time to have you on because we've seen a lot of volatility. We've seen a lot of uncertainty in the markets. And I know that working with my own clients, I've had calls and emails being like, okay, should I be freaking out right now? What should we do? Is there anything we need to change? What do we, just all the typical questions that might come up during a time like this, with everything with the new administration coming in, and a lot of uncertainty about things like tariffs and all of that, and how all of that and all the different layoffs in the federal government, how that is going to impact things in the economy. Talk about, if you will, with all that market volatility kind of rearing its ugly head here, how retirees and pre-retirees can keep kind of a level head and just sort of avoid those knee-jerk reactions that might be the, just plain human nature, that we want to kind of things get unsettled and we want to kind of freak out and make moves and feel like we have to do something, right? So how can people stay level-headed at a time like this?
Right. Vanguard founder Jack Bogle, I think, said, don't just do something, stand there. And I think that's often good advice in volatile conditions like the present, where people might have that urge to get in and tinker. I do think it's a valuable juncture to revisit a portfolio's asset allocation, how you are apportioning your assets across safer, more reliable and stable assets relative to those that have more volatility associated with them, but also better long-term growth prospects. And it really does come back to balance, where you're looking for a mixture of safer investments in those that have more growth potential, and kind of your ratio of safer to growthier really does depend on your life stage and your proximity to needing your money. So for people who are, say, in their 20s, 30s, 40s, I would say, to the extent that you could build a portfolio that is more heavily tilted toward growthy assets and just kind of tune it out, besides having your kind of emergency fund to help meet any unanticipated expenses. That's a really good strategy for people who are, I would say, sub age 50. But once you get over age 50, I think you do need to be much more attentive to having balance in that portfolio, where you have de-risked the portfolio a little bit. And that's been a tough sell because we have had fairly strong returns from the equity markets, especially US stocks. It's been tough to pry people's hands off of those appreciated equity assets. But at this juncture, given that stocks have been so good for so long, inevitably, we will have some reversion, and investors, especially those who are getting close to needing their money for retirement, will be glad that they went through that de-risking process.
Yeah, absolutely, and I totally agree. It's very super important that you know just step back, take a look at what you have, and make sure that you are properly allocated, especially at a time, as you say, like this, where we have that sort of juncture of market volatility right now, and the fact that the market trajectory has been up and up and up and up. Really ever since I guess the biggest, most recent downturn was back in 2020 at the beginning of COVID,
Mhm.
where the market just the bottom fell out, but very quickly recovered and has sort of continued that upward trajectory since. So yeah, it's a weird time psychologically. I feel like for people because it's well the markets are doing well. Why would I want to sell anything? I think that
Right.
it's great. But yeah, it's something that you have to sort of fight against. So maybe what are some maybe practical steps that people can take to de-risk some right now, especially given the fact that you'll this is sort of this attitude of you can pry the my securities out of my cold dead hands.
Right. Right. So for that sub age 50 cohort, I would focus my attentions on globally diversifying that equity portfolio. So I would still hang out with a fairly stock heavy portfolio. I don't know how you advise clients, Matt, but that's where I would come down. If you're under age 50, I would still stick with a stock heavy portfolio, but I would just make sure that I have a healthy complement of non-US stocks. So for people who haven't been paying close attention to this, non-US stocks have really quite dramatically underperformed US for several years running. And so at this point now, we have much more attractive valuations overseas. Dividend yields are higher overseas. And you also get a different sector mix overseas than you do with a US stock heavy portfolio. So the US market, as many people know, has been dominated by those big cap tech names. You still definitely want to make sure you are holding space for them in your portfolio, but they've probably taken over your portfolio unless you've taken steps to de risk. So, by globally diversifying, you are getting exposure to sectors that are pretty underrepresented in the US today. Things like banking and basic materials, energy is a smaller share of the US market than it once was. So, that's what I would focus on for the younger investors, just making sure that I'm globally diversified. And we have this style box at Morningstar that kind of depicts the allocations of the global market. And so you want to look for some kind of a dispersion of your holdings across that style box. You don't want to have all of your equity exposure clustered in that US equity box of the style, US equity square of the style box. So that would be the focus I would be using for people who are sub age 50. And then if you're 50 and above, de-risking should also include that check on how global your equity portfolio it is. But you also want to look at building out your portfolio's exposure to safer assets. So if you're, say, 50 or just above 50, you don't want to go crazy holding cash. You want to hold a little bit of cash, but you do want to be thinking about putting some bonds in place in your portfolio. And there I would look for a well diversified bond fund to do the job, or maybe a couple of different bond funds rather than trying to get too specific in terms of my buying individual bonds. I would just buy a good quality bond fund or ETF, or maybe a few different bond funds. So that would be the job for people who are getting close to retirement. And then for people who are in retirement, it's very much my bias that they have something like 7 to 10 years worth of spending needs. So the amount that they'll pull from their portfolio, hold that in a combination of cash, short term bonds, and intermediate term bonds, and generally keep the complexion of that bond portfolio pretty high quality. But the idea there with that 7 to 10 year runway is that you're building yourself a component of securities that if we have a really long bear market for stocks, those are the assets that you would pull your living expenses from. And that's kind of the basic idea behind a bucket strategy, which is something that I talk a lot about in my work.
Yeah, absolutely right. And yeah, no, and I agree with so much of what you just said, because it's like, especially the whole, but the three rules of investing: diversify, diversify, diversify. That's so important. And not just to be diversified in US equities, not just to be diversified in different, companies, not just to be diversified in things like that, but make sure you're diversified in different asset classes, you're diversified in different markets, and different types of investments as well. I often, encourage my clients, and again, all of this depends on your individual situation. But I often encourage clients, if they are hesitant maybe to invest in bonds because they may have seen that bonds have been underperforming the last couple of years,
Right.
I will instead encourage them to go to like an annuity or something like that, where they can get still that safety that they need inside their portfolio, but then they could also get some market growth as well. If it's a fixed indexed annuity, the potential for that market growth. So there are different, things to look at for the individual. And so much of it too. And it's funny because as I was telling you just before we started recording our conversation, that I just had a client meeting prior to us getting together here. And it's funny because he was asking me to be his psychologist with this. He was like, do I have to pay extra for that? And I was like, no, it's fine. I do what I can. But there's a certain, sort of behavioral, psychological um, determination to all of these different moves that people could probably make. And I want to do more studying into that. There's a certification out there, I believe, a behavioral finance certification, that I'm so interested in because I find this so fascinating. Like, what psychological or behavioral finance tips do you have for people who sort of feel compelled to do something when the markets are choppy, instead of just, turning or tuning out the noise?
Yeah, and I think I've heard from advisor friends that that's really not a good answer for clients, that we're just going to do nothing, that sometimes you do have to do something. And so, I would say maybe there are a couple of constructive activities that you could look at instead. So I'm a big believer in people streamlining their investment portfolios. If you've been working for a while, you probably have multiple IRAs with various firms. Things are more complicated than they need to be. Can you put your attention on that? Like figuring out, okay, how about shedding some of these accounts, consolidating with a single firm or a couple of firms? So that's a good sort of way to burn nervous energy, I would say. Conduct a cost audit on the holdings in your portfolio where you're looking at, okay, am I overpaying for this fairly generic type of investment? That's another activity that you could engage in to maybe do something that's productive, but isn't going to be reactive. Because I think that's what you want to be super careful about, that you're not just reacting to whatever's been going on in the headlines. We see people get themselves into some really difficult spots by being reactive. In fact, we run this annual study called Mind the Gap, where the gap is the gulf between a mutual fund's published total returns and the amount that shareholders actually earn. And what we see is that there's oftentimes a disconnect because of some of these bad timing decisions, that people see the fund or the ETF that has performed really well and they glom onto it after that. And then they capitulate when the investment doesn't perform well. It's just kind of like wash, rinse, repeat with this cycle. And it's something that we can actually see and measure. And so investors do have to be aware that this is a risk. It's something that we see that investors do that systematically undermines their wealth.
Yeah, you freak out, for lack of a better term, and then you essentially, if you freak out, you sell, you lock in your losses at that point, and then you miss the bounce back that inevitably happens at some point thereafter. So it's not a good formula, right, for success. And so just be, I guess that my mind always goes back when I'm thinking about this. My mind goes back to that it's the old British World War II poster, "Keep calm and carry on."
Right.
So much of it is that, because you don't want to have that freak out moment. And hopefully, if you're working with a trusted advisor, if you're working with someone who is a professional in this field, you got somebody to sort of talk you off the ledge from doing that. I think that's extremely important as well. And
Absolutely.
I mean, a lot of obviously the show is called Take Pride in Retirement. It's focused on LGBTQ plus folks, and I think that there's also a lot of uncertainty amongst the LGBTQ plus community right now, especially given changes in Washington, federal recognition of transgender folks being kind of taken away, at least in the different federal government departments and things like that. So there's uncertainty about, okay, what may be next as far as that goes, or what could be on the horizon for my particular community. So from a financial planning perspective, from a financial planning standpoint, what should LGBTQ plus folks kind of be focused on, especially with things like, estate planning, retirement benefits, marital issues, things like that, just from the financial side? That just because there is so much uncertainty, I feel like we all need a psychologist right now in the
Right.
LGBTQ plus community. What can we do?
It's a great spot to get some advice. Certainly in the estate planning space, I know people will see that there are services, online services that can help, and I think they've gotten better, but I still think there's no substitute for some sort of human estate planning guidance to walk through what are invariably very individual decisions that you might be making, and they may be able to help help you find some comfort that, oh, in our state this probably isn't going to change overnight, or whatever the case might be. So I do think that for people who are anxious or who simply haven't revisited their estate plans for a period of time, it really makes sense to get some guidance. And the same goes for financial planning guidance. Matt, you and I were talking before we got going, and I know this is a particular niche for your practice. And I do think that it makes a ton of sense for LGBTQ folks who, do want that advice that is very customized to their own situation, that they look for someone who has that as a niche. So I love that idea of getting that personalized guidance, because I know it is a time of deep uncertainty for a lot of people.
It really is. And, as we always say, as I always say on the show, and this is the reason that the show exists really, is that no matter who you are, where you come from, who you love, how you identify, or how much money you have, you deserve to have a retirement you can take pride in. And that is why the show is called what it's called, and why I do what I do. And so that is, I thank you for saying that and for pointing that out, because I do think it's paramount right now, especially for folks to have that personalized guidance. And no matter if you are part of the LGBT community or not, you need personalized guidance a lot of the time, because it's a complicated world that we live in. Finances can get complicated. And so I feel like at least just having another set of eyes on your finances can really, really help, see through that fog and help you make better decisions going forward. And I know that obviously this is one of the reasons that you do what you do as well with folks, and also with people in wider numbers, because you have written, as I say, quite a bit. And this book now is very, I love the title is so simple that it tells you exactly what it is. It's How to Retire. I love that. What inspired you to write the book, and how have your experiences in life that you've talked about before at Morningstar and elsewhere? Of course, you've been at Morningstar for 30 plus years. But has your experience at Morningstar kind of affected and shaped the priorities that you like to share and the advice that you like to share with folks?
Sure. So I have gotten super interested in the process of retirement decumulation, constructing a portfolio to support someone's cash flows through retirement. And there are a couple reasons why. One is just from a research standpoint, there's way more to talk about in the realm of retirement decumulation. So you can talk about the role of, income producing products. You mentioned annuities earlier. You can talk about Social Security strategies, how to have a plan for long-term care. It's just a really diverse set of topics that there are to research. And then I was also attracted to the topic because there's so much that's suboptimal about how we do retirement decumulation in this country, where if you are working and you're contributing to an employer provided retirement plan, it's just sort of going along. You'll probably be defaulted into something if you make no choice. Well, when it comes to retirement decumulation, people hit their retirement years and then they're handed this pot of money and kind of told to figure it out, which is not great, right? We know that people experience cognitive decline at a higher rate as they age. There's a lot that is not great about handing people their pot of money at retirement. So there's just a ton to talk about. And the idea with the book was to make each chapter a lesson in how to do some aspect of your retirement. And so each chapter is an interview with a thought leader in a specific area. And the nice thing about that format is that it didn't require me to be an expert in every single one of those areas. In fact, I'm kind of as a person, I'm kind of a Jeopardy player where like I know one or two things about a lot of things, but I don't know a lot about some of these topics like healthcare in retirement and housing choices in retirement. So the idea with the format was that we could go deep on a broad swath of topics, both financial and non-financial.
I love that. I'm the kind of the same way as you with, and it's so funny. My husband and I every night we watch Jeopardy, and I'm right there with you. I am all I'm all over. I will know a little bit about all of the different categories. Really, well, the opera not so much. Which opera appears a lot? As opera and mythology tend to appear a lot on Jeopardy. I'm not quite as good on those, but the others I'm pretty good at. But yeah, it's like I know a little bit about a lot of different things, but some of these areas, you kind of need help on. And so you got that expert, input on all of these different topics. Going back just a little bit to maybe even the LGBTQ plus community, is there anything in the book, maybe any chapters that sort of stick out to you that might be specifically helpful to the LGBTQ plus community that you wanted to highlight?
So one through line in the book is this idea of lifetime giving, and this is something that you and I talked about in advance of getting rolling here, but um, I've become a huge believer in lifetime giving to loved ones and to charity versus leaving it all at the end. And it does require a little bit more calibration in terms of the retirement spending plan to give yourself permission to make those lifetime gifts. But I think it may be relevant. I do not have children, and I know some people in the LGBTQ community do have children, some do not. But to the extent that folks don't have that very strong bequest motive, where it really does matter that they either enjoy the assets that they've managed to save or that they give them away, at least in part during their lifetime, it can be a really rich part of the planning to discussion to think about, okay, what are some of these gifts that I could potentially make potentially in my lifetime to see that money working for me during my own lifetime versus leaving them to others after I pass away. So that might be a topic that is of some relevance to your audience, I would think, Matt.
Yeah, I believe definitely so, because so many, as we've discussed, everybody's situation is different and everybody's family looks different. And
Right.
so, and I think too that with that sort of lifetime giving in mind, you actually get to see sort of the fruits of your labor during your lifetime instead of, and it's good. There's a lot to be said for, okay, well, I know that after I'm gone, so and such organization or group or cause that I'm really passionate about will benefit from this gift that will be given to them. But actually seeing that happen, I believe, is a very good thing, and that sort of ties back into the whole psychological part of investing too. It's like, what do you want and what will be more psychologically beneficial to you, and give you more satisfaction during your own lifetime. And I love that. Now there are just a few more minutes here left, and I wanted to talk about some specific maybe resources or tools that people can take advantage of. Obviously, there's the book, which again is
Mhm.
called How to Retire, which I would highly recommend because there's a lot of great stuff in there, a lot of great nuggets that people can take away to really help give them a comprehensive look at their own retirement through the lens of all of these different experts that you were able to speak with for it. And but what other resources? Morningstar, I'm sure, has a ton. You do a lot of research. There was I know one report that we had mentioned before that I wanted to actually mention here as well. That's that the state of retirement income, I believe, that comes out on
Right.
a yearly basis. So that is a good resource to at least give people an idea of sort of the drawdown of income, the decumulation in retirement as well. But are there any other resources that you would recommend for people who are looking to sort of stay calm during these times, and really just, at least if even in more calm times, stay on top of changes in the markets and shifts in even things like monetary policy or legislation that could affect their finances as well?
Yeah, we have a lot of resources on Morningstar.com. There are people who are, we have a markets team that I think provides pretty sober coverage of the market environment. Our strategy overall at Morningstar, our approach is valuation and quality conscious. So that's kind of a bias built into almost everything that we do. So I would urge people to check out some of the work that our economists are doing. Another little tool that I would urge people to check out is this market valuation graph that we have available. And it's something they could just type in Google Morningstar market valuation graph. And basically, it shows the price to fair value of all of the companies in our global coverage universe relative to it shows our estimated fair value relative to what we think the company should be worth. And so it's just a little bit of a temperature check on the market. I looked before we got on here, Matt, and I think the typical stock in that coverage universe was trading about 4% overvalued. So not a lot. But I think it's kind of a nice tool to just kind of get your arms around where the market is currently. This is the stock market. And there will be points in time, like when stocks sell off sharply, you'll see that graph react pretty quickly too. So if stocks do incur some losses, well, you see actually stocks are getting cheap during that period. So that's a nice incentive to stay the course, to not get too cute in terms of trying to time things around. So that's another tool that I would urge people to check out. I think it can be kind of a nice anchoring device in volatile times.
Yeah, absolutely right. Are you getting the value that you're paying for? And are you overpaying for something that's underperforming, or that kind of thing? I think that's a great tool to keep in mind. Well, Christine, anything else that you wanted to mention that we haven't gotten to talk about just yet that comes to mind before we wrap things up?
Well, one quick thing, Matt, I work on this annual white paper that is about diversification and what assets work in a portfolio and which do not. And so the short answer there, and it's a long white paper where we have a lot of graphs and a lot of detail, but the short answer is that keeping it simple in terms of your portfolio's asset class exposures goes a long way. So if you have US stocks in your portfolio, the next best asset to add for diversification is usually kind of US government bonds. Very boring, very vanilla. But I think to the extent that people have that mantra in mind, that keeping it simple when it comes to portfolio building is a really good strategy.
Yeah, keep it simple. I love that. Well, Christine Benz is Director of Personal Finance at Morningstar, also author of the book, How to Retire 20 Lessons for a Happy, Successful, and Wealthy Retirement. Christine, it has been an absolute pleasure. I really thank you for your time and hope to talk to you again soon.
Matt, thank you so much. It's been my honor.